excited to rev up for a nice weekend drive, or a safe minivan filled with entertainment features for your children, cars are everywhere. There are more than 275 million vehicles on the road in the United States.
People, they equate cars with freedom. There is this way in which it gives us an ability to explore and see and expand our lives.
But in recent years, owning a car has gotten expensive. Really expensive. More than 100 million Americans have an auto loan, and auto loan debt in the U.S. is currently at $1.5 trillion, a record high.
Outside of purchasing your first home, a new car or an auto is the second largest purchase for most people. Given the transaction prices and vehicle prices today, financing is required to buy these vehicles.
In 2023, the average monthly auto loan payment for a new vehicle is $725, up from $650 in 2022. The average monthly payment for a used vehicle is $516 in 2023, up 2% from the prior year. Meanwhile, consumers don't typically cast their car buying
That's the 2023 numbers. Now in 2024, the monthly payment of an auto loan is close to $800 a month. And you add in $300 to $400 a month of insurance, because even insurance, in addition to auto loans, are going up as well. It is skyrocketing and it's getting more and more expensive.
experience in a positive light.
It was a very quick process, and I did feel like they just wanted me to sign at the bottom line as quickly as possible.
For years, complaints and lawsuits have been popping up left and right against lenders for alleged discriminatory and illegal practices.
It undermines my trust.
Our number one priority is to our consumers. And so we have put a variety of processes in place to ensure that is the case.
So what's happening in the auto loan industry, and what can consumers do to make sure they're protected? Just like any other loan, an auto loan is a lump sum of money you're given to purchase a car. Money you're borrowing and have to pay back over time. Once you've been approved for a loan, often including a down payment, you can drive your new or used car out of the lot. But it's only yours as long as you make monthly payments. With interest, of course. Take 32-year-old Sean Miller, for example. In 2019, he bought a new car for just more than $48,000. He put down about $10,000, locked in a 3.89% interest rate for a 72-month term, and now makes monthly payments of about $590. By the time the loan is paid off, he'll have paid nearly $5,000 in interest. And then there's a caveat. Until you fully pay back the loan, the lender holds the title and can repossess the car at any time if you fall behind on your payments.
That's with the interest rate back then. Now in 2024, your interest rate for a new car, if you have good credit, you're looking at about 7 to 8%. And if you have not so good credit, you are looking at 12 to 18%. That's for new car. If you're buying a used car, you can add another 4 to 5 percentage point to that. So your monthly payment can go up very quick, and therefore now we have an average monthly payment of $760 or $80 a month. It is that bad.
Noelle Saldana was at work when her husband called to say their 2011 Acura had been stolen right in front of their East Orange apartment building with their one-year-old daughter Hannah in the back seat.
Just got back to working. I got a little behind in my payments.
Repo guys going into your driveway in the middle of the night and taking your car. That's one way. They have these switches that can turn the cars off.
There are direct and indirect lenders. A direct lender would be your local bank, credit union, or an online lender. Once you're approved for a loan through a direct lender, you can then head to the dealership and shop around for your car just like a cash buyer would. As for indirect, that's when you go to a dealer and they provide you with financing options as you're buying a car. For example, you might be at a Subaru dealer and you just picked out the perfect car for your family. The dealer sends your financial information to Chase. Chase checks your credit and other financial factors and provides the dealer with an interest rate and loan terms. Then, the dealer presents you with their interest rate and terms, and if you agree, you sign and get to drive away with your new car. It's more of an all-in-one process, and about 80% of auto loans are estimated to be indirect. Now, regardless of if you're choosing a new or used car or direct or indirect lending, one of the most important factors that will determine the interest rate and loan terms you're offered is how confident the lender is in your ability to pay back that loan. They look at your assets, liabilities, income, expenses, and most importantly, your credit score.
Our primary goal is to put customers in financial products that they can afford.
Chase Auto tells us they service consumers with a credit score of 620 and higher, with the average credit score typically in the 700 range. Toyota Financial Services holds primarily a prime credit portfolio, meaning they service those with very high credit scores. They tell us the average is 744.
But we do support a larger spread of business, and those with maybe lower FICOs may come to the table with larger down payments to help that affordability.
Toyota is currently the market leader for auto loans and leases. In 2022, 5.3% of total auto financing came from Toyota Financial Services. 4.4% came from Capital One Auto Finance.
The partnership that we have with the divisions is what makes us extremely successful. We've got a concentration and a focus on our customers and our guests and our dealership partners.
According to Toyota, the company's financial services business consists primarily of providing financing to their own dealers and their customers. The business also provides mainly retail installment credit and leasing. Sales revenue for the financial services business for fiscal year ending in March 2023 increased by nearly 21% to 2,809.6 billion yen from 2022, which is about $19.8 billion. That's compared to its much larger automotive operations business that saw an 18% increase in sales revenue in 2023 from the year prior. The Japanese automaker is the largest in the world.
The industry's going strong. We're continuing to recover. Consumers are out there buying vehicles. The demand is there, and the lending is there.
They're losing their jobs, and these firms are going to go out of business, and he's
global chip shortage still hampering car production.
The rate of inflation soaring to its highest level in over 30 years.
More than half of auto financing is by non-bank finance companies such as the financing arms of automakers. These lenders typically rely on short-term funding markets for their own financing. So with volatile markets, especially the case of short-term funding markets drying up during the global financial crisis, the past couple of decades have kept auto lenders on their toes, to say the least.
We went from a time of easy credit to now a time where we're more credit constrained, and because of the risks of inflation, even more credit constrained, right? Because of the interest rates that have gone way up. That is a huge problem.
In the first quarter of 2023, the average interest rate for a loan on a new vehicle reached 6.58%, up from 4.1% in 2022. That's an about 15-year high. Average car prices are also at a high. That's partly due to supply chain shortages, higher demand, and inflation. That also means Americans take on larger loans at a higher interest rate. In the past 10 years, outstanding loan debt has doubled, and auto loan debt in the U.S. is at a record high. Younger Americans are also more in trouble than they've ever been in. In 2022, $20 billion in Gen Z and millennial debt had fallen into serious delinquencies.
I'm paying a ton of money right now for a car that I don't really need. I've been struggling to sell it. If I were to sell it today, it would probably be a $10,000 to $15,000 loss.
Miller rented his car out until someone crashed it.
And that's the problem with a lot of people that bought their car during the pandemic. The price is so high because of the supply and demand, supply being stuck and shutting down while demand with the stimulus money is sky high. Therefore, you have a lot of high prices and a lot of consumers are overpaying and that will get them in trouble in the future when they trade in or they try to sell their car. Their car will be underwater, or meaning that they owe more than the car is worth. And because of the pandemic and overpaying of the car during COVID, you have a lot of people that couldn't afford their cars, and now repossession is skyrocketing, and people are losing their cars because of that. Now you see a lot of repo, and they have a hard time hiring tow truck and repo guy right now to go out there and repo these cars that are late or missing payment.
He's tried to sell it, but hasn't received an offer that makes financial sense.
It's going to be at least another 3 or 4 years of owning the car before I'm able to pay off the loan. This is something that right now is preventing me from being able to save up in order to start a family.
He's not alone with his concerns, and these changes are hitting lower income consumers, those with credit scores below 620, the hardest. The Fed's interest rate hikes are squeezing them out of the market.
What we're seeing is another manifestation of what we saw during the subprime crisis, which is that lower income people lost their homes. And lower income people are having difficulty getting cars, getting mortgages, and they're also at higher risk of default.